Welcome to Build a Business Worth Buying, the podcast where seasoned entrepreneurs, M&A experts, and world-class operators share behind-the-scenes stories of building, scaling, and selling remarkable businesses. I'm your host, Aaron Alpeter, and every week I sit down with people shaping the world of acquisitions, founders who cashed out, buyers with bold strategies, and advisors who help make deals happen. This is not a podcast for beginners. It's for those who know the grind and want actionable insights to make their next big move. Get ready to take notes, rethink your strategy, and hear untold stories of what it takes to build a business worth buying. Today's guest is Kelcey Lehrich. He's the co-founder and the co-CEO of 365 Holdings, which acquires, operates, and scales businesses. They started out in services and now do direct-to-consumer businesses. They're based in Akron, Ohio, and they've been founded on the belief that the future of the consumer spending belongs to a new class of what they call micro brands. These smaller, digitally native businesses that connect with customers through modern media, community, and not necessarily mass advertising. This is a fantastic conversation. I really enjoyed getting to know Kelcey. He talked a lot about how they evaluate deals, how they evaluate if it's a good fit, how they think about multiples and those sorts of things. So if you've ever had questions about what an acquirer is looking for and how they're evaluating your business, this episode's for you. Kelcey, thank you so much for being on Build a Business Worth Buying. How are you doing today?
Great. Thanks for having me.
Of course. So I want to dive right in. You've been running 365 Holdings for over 15 years, and you bought your first e-commerce business in 2017. So I guess I'd love to understand how did your focus change over that time, and how did you end up where you guys are today?
I am one of two folks that's a founder in the company. My business partner, his name is Justin, and we started buying small companies more than a decade ago. It's been about 15 years now. And we started with offline small service businesses. We didn't have any outside investors. There was no piggy bank or nest egg. We were buying incredibly small service businesses through a series of kind of really scrappy small acquisitions, a lot of seller financing, and a lot of it kind of by hook or by crook deal making. We ended up getting one small business sold for $100,000. And we went shopping for a quote unquote real business, first actual company with employees and history and whatnot. And we bought $1 million purchase price e-commerce asset with $100,000 down, $100,000 seller note, and an $800,000 SBA loan. And that was 8 years ago. And that kind of set us on this path of evolving from this really small, scrappy, entrepreneurial service business model we had been in to focusing on e-commerce. And about 90 days after we bought that first asset, we maxed out the line of credit and drained the checking account and bought our second one. And the rest has kind of been a rinse and repeat of that. So fast forward to today, we've got a handful of brands in the portfolio. We've been doing mostly special situations the last couple of years. So buying distressed assets through lender foreclosures or looking at bankruptcy bids or corporate carve-outs, things like that. But the kind of the through line has been a focus on e-commerce for about 7 or 8 years now. And we're just looking for great quality brands to hold on to for a long time and keep in with kind of the classic holding company model.
So that's interesting. So you guys started out with these services business. Was the idea that you would just kind of take over something that somebody didn't want to do anymore and you put your own sweat equity into it and then live off the cash flow? What was the initial idea behind that?
The idea was we both wanted to be self-employed, didn't make terribly good employees for other people, and also didn't have a lot of capital. So we needed to find a way to buy businesses. And we were very attracted to opportunities where with not a lot of cash, but with a lot of sweat equity and effort, we could build up a base. So yeah, we were just compounding cash flow at a micro scale.
Yeah. And what did you learn? What was different going from these services pieces to your first e-commerce business to now all the other ones that you have?
Yeah. I didn't set out to get into e-commerce as a top-down strategy. I didn't wake up one day and say, you know what, I really want to build a portfolio of consumer products businesses. We somewhat fell into it. And I would say that now that we've been doing it for a while, we've got a bit of a competitive advantage from having been in the space and been operating for a while and seeing a lot of things. So while it wasn't an intentional focus, I think having a focus has given us an edge where, again, seeing and doing enough in any industry and becoming an expert in that category allows you to really have a better lens to evaluate opportunities. And so we've just kind of built up this muscle of being effective in the e-commerce space. It's probably why we like doing the turnaround and special situation work now, because we've seen enough to know how to add value to those businesses.
Yeah, that's interesting. And when you look at these businesses, is it more of a function of better management and that's how you're going to get the value out for it? Or is there something where, I mean, you have these special situations, these messy things are kind of what you're looking for. Is it because you think you can out execute folks, or is it something that's a little bit different there where that's just the nature of where you play?
We're trying to find value, and value is part of the inherent business model that exists. How good is that product at delivering value to its customers? And why are we going to be in a position today to acquire that business and create more value in the future? So if it's a great product and they have a balance sheet issue because they got caught sideways with some lenders and they have a tariff problem and Facebook did something and the business just has a temporary disruption, it's an easy series of things to say. It's a whole different thing to be astute in underwriting that risk and being able to confidently execute a turnaround with your own dollars to do it. So what I think we've developed is the ability to have a strong conviction of when we believe we're able to affect real change in a business, what projections, what forecasts, what challenges, what changes we're comfortable underwriting to. Everybody wants to give a projection of their business that looks really great. I do the same thing when I go to sell a business. I don't begrudge that to anybody. I just think we've got a more refined view of the risks we're willing to take that lets us get into situations where we know we can win.
Yeah, that's interesting. Can you say more about risks that you're willing to take versus not willing to take?
For sure. We are really, really comfortable with deeply operationally intense assets. We actually prefer a business that has a supply chain moat. So we own and operate manufacturing in a few of our businesses. We really like having control over the product because that's the delivery of value mechanism to the customer. The better that product is, the more there's a willingness to pay from the customer to do that. We are really, really happy to invest in businesses where we can see a large addressable market that has some clear gaps in marketing, whether that be on the demand capture side of Google and Amazon, the demand creation side of Facebook. I'm really comfortable to be able to tell the difference between somebody saying, hey, I think there's opportunity to do more advertising, and having a good opinion for myself if I believe us and the team we would put in place can actually execute on that versus not. Again, everybody's selling a business. I don't begrudge this, but they want to talk about the opportunities. And I just think we've been able to develop a lens of what opportunities we believe we can execute on and have some confidence in how to underwrite those on a go-forward basis. I've never seen a broker that doesn't have a chart that goes up and to the right. My charts also go up and to the right, but I've also bought a lot of businesses and I know they don't always go up. Like, we've had plenty of mistakes and plenty of duds. I get it. It's being able to develop a muscle to know which ones I've got better conviction in.
When you are the acquirer and you're trying to suss out, okay, your chart says up and to the right, what are some of those things that maybe give you pause or suggest that, hey, this thing has some risk to it, and we're okay with that, or we're gonna knock down your chart a little bit?
I'll get a recent example. There was a current year financial and then 3 years of projections on an annualized basis, and we're recording this in November, so it's kind of a darn near full year 2025, and then projections 26, 27, 28. And I asked the banker where the margin expansion would come from in those out years, because every year gross profit got 1 or 2 points better. And I just said, like, what are we basing that on? Is it pricing from the manufacturer? Is it pricing to the customer? Like, what is the input to that? And I got back a banker speak, very vanilla answer that was like, we just made the chart go up, which is fine. Like, they can do that for their projections. I'm just not going to do that in my model. I'm going to keep my model flat because I don't think I'm going to raise the price by that much. I don't have a reason to believe that yet. And I haven't talked to the vendor to qualify that they're willing to go cut their price by certain percentage points that probably don't want to unless we have more volume for them. So I'm going to underwrite it as flat. And knowing, that's one example out of many, where on a financial model you can pull those levers and where you can't. I've got another recent example where they wanted to add back a lot of synergies around overhead. We take an approach where we don't do synergies between our portfolio companies. So it's, hey, you already have an ERP, you don't need ours. I'm like, well, even if that was true, it would cost a lot of money to move all the data from your system to ours, and we don't have an expense for that, and there's a whole conversation. So those are the things that I might not have caught 5 years ago, or not had a robust analysis for that we do now.
Yeah. So do you kind of just fall back to just a multiple of cash flow at that point for what you're willing to pay today?
We are fundamental financial buyers bidding on a multiple of cash flow. We want growth. We want a quality business. We want a great asset that we believe in. But we are fundamentally buying a multiple of cash flow the same way people buy a landscaping company or a delivery route business or an IT services company or whatever.
Yeah, no, that's great. When knowing that it's so interesting hearing this, because I think so many founders, they try to put a intangible value on the goodwill, the brand, these other things are in the pipeline. But it feels like with all of the acquirers that I talk to, it all comes down at some point to multiple of cash flow. And so I'm wondering, as you talk to potential sellers or people who are thinking about selling, what are some of the things you wish that they understood better about the process that would maybe impact how they get their business ready to sell?
I would encourage folks to say that 98 or 99% of deals are a financial buyer underwriting to a multiple of cash flow. And I don't begrudge anybody a really great outcome. If you can build it something that scales to the moon and gets a revenue multiple and all these kind of outstanding extraordinary results, you absolutely should do that. And I would applaud you and encourage you to do so. I'm probably not going to be the one that buys that from you. And statistically speaking, that's a small number of businesses. So with those facts in mind, if somebody thinks that I should be talking to them, I would just say to them, like, we're going to have a very sober, rational view of an economic financial model for the business. If your aspiration is to get a revenue multiple by selling to a public company, you should do that, but you're wasting your time by talking to me or anybody that looks like me. And it's just not most businesses. So most entrepreneurs, including the assets that I am and that we eventually exit, are going to be exiting on financial terms. And it's the way that the vast majority of transactions, 95, 98% of them happen. I'm cheering for you. I want you to win. I want you to do that. But the statistics are what they are as far as deal outcomes.
Yeah. Do you think that those 2 or 5% of deals that are, call it the headliner deals that everybody points to and says, this is what I'm going to be when I'm an entrepreneur when I grow up, do you think those are mainly mistakes, or is there like a rationale that would say, oh yeah, it's worth paying through the nose to do these sorts of things?
There's a rationale. I don't think I'm Elon Musk. I don't think I'm Mark Zuckerberg. I don't think I'm Steve Jobs. There are really, 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 really good entrepreneurs that I think are building better businesses than me, and they deserve to get better economic outcomes than I get. Statistically speaking, there's only a handful of those really outlandish entrepreneurs. And so people thought Zuckerberg was crazy when he paid $1 billion for Instagram. People thought that Google was crazy when they paid a lot of money for YouTube. You can go through these different examples, and they happen in consumer. They do happen in CPG and in apparel. Those things absolutely occur. The benchmark for where and how they occur is pretty far from where most entrepreneurs' businesses are today. The apparel deals that go for big numbers, the things that Procter & Gamble buys, the actual business metrics that drive those don't look like a lot of the business metrics of a lot of small companies that go hunting for those outcomes always, whether it be margin profile, percentage of revenue on subscription, overall size of business. If it's a business that's you're comping to that did 80 million in revenue last year and you did 4, you're just, again, no offense, you're just not playing in the same ballpark. You're going to be dealing with very, 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 very different outcomes just from the quantum of the business size. So again, I'm cheering for everybody to go get those outcomes, but they're just different outcomes in different businesses.
Yeah, that's helpful. So knowing that we've kind of anchored that at the end of the day, the root basis is a percentage or a multiple of cash flow, how do you determine what that multiple is for a particular business or category?
Again, we're kind of fundamental spreadsheet buyers, whether the business is an e-commerce asset, a physical product seller that's going into brick and mortar, an Amazon business, kind of pick your flavor of consumer products. It's kind of immaterial to us. It could be a landscaping company, and I'd probably still have a similar underwriting model of most small businesses, e-commerce or not, are going to trade for 3 to 5 times earnings. And so that's regardless of industry or classification. Now, the better quality the asset is, the higher that EBITDA multiple or earnings multiple is going to be. The more recurring revenue, the more the growth, the more defensible the market position, the more attractive the margin profile, the more tenured the team, the overall size of business. Those are all things that notch you up that scale. But it's unlikely that hitting all of those things goes from a 5 times multiple to a 20 times multiple. The math just doesn't work at those scales. So 3 to 5 times is a range, and we're going to apply a subjective measure of quality for how attractive that asset is to us, what we see as valuable about it, what our outlook for it is, and the more excited we are about it, probably the higher multiple we're going to bid for it.
Got it. And in the excitement level, is it just more of a, hey, you think that you can hold this for 5 or 10 years and you can quadruple the size of the business with relatively little effort? Or is it more of a, hey, this sector is really, really hot and we think that, someone will want this even if it kind of sits around?
I really think mostly about durability and quality of the business. The more trend-based, hits-driven, trend-focused the asset is, the less durable or attractive it is for us. I would rather see a business that's 20 years old, growing 10% year over year. I'd buy that all day long versus a business that's 3 years old, growing 50% year over year. I would rather have that steady, predictable, more high-quality business model that's more defensible. That's our preference for what we go looking for.
Okay. And when you get a potential deal, like what are some of the things that help you look at a deal and say, hey, this is really clean. This is going to be a slam dunk for us. We don't have to dig too hard. And what are some things, conversely, that kind of scare you away or give you pause?
Yeah, the quality of the financials that are put together. It's really easy to tell when financials are heavily adjusted or just aren't really done well and tight by a great bookkeeping firm or great internal accounting team. Truly, after seeing hundreds and hundreds and hundreds of financial files, it does just get kind of easy to kind of glance through a chart of accounts and start looking at some trends and data to understand how much attention to detail went into these before I go digging. Even the cosmetics of how that file is prepared can tell a lot about what's likely to happen once we dig in. Looking at one right now that's supposed to be accrual accounting, but COGS goes negative in some months. Yeah, we have revenue. So we know something is not correct in this file.
Okay, sorry. Yeah, that's good. What else do you see outside of messy or inaccurate math in the financials?
I like it when there is a clear objective from the people selling the business. I really, really want to exit. I really want to stick around for 6 months, then I got to go do my next thing. I'm selling because I need the money and I'm going to go do X, Y, Z next. Many times, it depends answer. Maybe I'll stay, maybe I'll go. Actually, we might not sell it all. We might raise money and go crush it. We're exploring options kind of answers. I don't begrudge it, but I don't take it as seriously as I take somebody who says, I need to sell the business. I'll give you 60 days and then you got to hire my replacement because I'm out of here. That is much easier for me to pursue with confidence and conviction because I have clarity on what we're trying to accomplish. When somebody's very, very open and very, very flexible, occasionally you find a really great opportunity, and occasionally it's hard to get aligned on the same page and find a great match between a buyer and a seller because there's not enough clarity on what is trying to be accomplished. And you end up making a lot of proposals that end up not getting any traction because there was no objective from the outset. So in addition to clean financials, have an objective, have a plan, have an ask of what you want to accomplish in the deal. Makes it a lot easier for a buyer, me, or anybody to know what to expect and try to give you what you want so that you can close.
That makes a lot of sense. I feel like so many times people kick the tires because they want to know what the business is worth. And you kind of told all the listeners it's 3 to 5 times earnings.
Yeah.
And so it's one of those things where it's like, that's probably where you're going to be. If you do find someone who's like, oh yeah, here's 20x, you should take it, no questions asked, almost. But
for sure,
that's really interesting. I mean, I'm curious when you start to look at these things and you start to assess, and the buyer is sincere, or he looks at, how do you dig in more to figure out, is this a durable brand? We talked about that a little bit, versus, hey, this feels like it could fall apart if this person is leaving in 60 days.
Yeah, we would look at that from a couple of angles. So one would be the go-to-market side of things. How diverse are the sales channels? Is it D2C? Is it Amazon? Is it in wholesale? How much channel concentration do we have? Is there retention marketing with email and SMS? We start to look at the quality of revenue and how diverse or concentrated it is by method of getting the order. So we can get an order on Amazon. We can get an order from a Facebook ad. We can get an order by having a great brand and doing a marketing calendar and having great social media. We should be doing all those things. Like a diverse omni-channel business is great because you have many, many levers to pull. So we want to look at how robust and durable and diversified is the go-to-market side of things. Same thing on supply side. Are there best-selling SKUs that have been around for a long time? Have they had marginal, incremental, consistent, repetitive, small improvements like the iPhone? We're on, 17 or whatever it is now. Every year they're coming out with something new and making that product a little bit better. We want to look at the history of those SKUs, how diverse or concentrated are those product lines, and what has been happening through time to give customers more value to keep us competitive in the marketplace. That kind of supply and demand lens really drives a lot of how we view and underwrite businesses. Is a solid team a good thing? Of course it is. Is documentation a good thing? Absolutely. Can I fix both of those problems if the team quits and there's no documentation? I can. Not every buyer can, but we generally are able to if it's a good business. Good business being supply and demand that actually have durable, sustainable characteristics underneath them.
I love how you frame that supply and demand piece. I want to kind of double click and challenge something that I've heard a couple of times. And we'll start with the omnichannel piece. I've heard the argument that, hey, we actually like the idea that you only have one or two channels because we see expanding or taking into other channels as a positive and something that would make us believe that we can grow this business faster, do things like that. So the classic example is, if you are selling to a strategic and you're only D2C and you've just dipped your toe into retail, strategic may say, I can buy this, I can take it international, I can put you in all these retail, and so that has value to me, as opposed to, hey, you've already done all these things. It's maybe you're there and it's not performing as well, but it is there. How do you reconcile those? Which one is better in your opinion?
We look at a lot of products and businesses in the lens of, is it demand capture or demand creation? So demand creation is I run Facebook ads and I do social media and I'm getting people interested by solving a problem with a solution and giving them a product to identify with and a brand that creates value by solving a problem. Demand capture is I want to buy something, so I type it in. Amazon, Google, doesn't matter, but I am just searching for something. In general, we really underwrite those characteristics differently based on how we view the business. And so to answer your question about omnichannel, when somebody has a very demand capture business and 1% of the revenues on Walmart.com, like, it's a great opportunity. My candid opinion is it's not a great opportunity. We're capturing demand. Amazon's a certain percentage of e-commerce. Direct to consumer is a certain percentage of e-commerce, with Google being its front door. And Walmart's also a certain percentage. There's only so many people looking for your category of widget in the world because you're capturing demand. You have I'm selling umbrellas. I don't know who has an umbrella company, so I'm not picking on anybody. But they only sell so many umbrellas at Walmart, and we're only going to get so much market share. And it's really hard to go get more market share unless you make an umbrella that flies or that repels water or it costs next to nothing. You have to go do things that are hard to do to really capture market share. So I don't know why we'd grow the Walmart channel. On the other hand, if you have a demand creation business where you're solving problems with unique value props and you're going to market with new and novel things, it could be a really good idea to open up Target or to go into Whole Foods or do these different growth mechanisms for a business. Whether the acquirer likes those different channels depends on the acquirer. I would say for us, just really candidly, I tell everybody this. We're great at D2C. We're pretty good on Amazon. I struggle with wholesale. Unless your business has a good wholesale mechanism, I'm going to underwrite it very flat because we don't have a tenured, experienced, strong talent bench in wholesale. If your business has one, I'm happy to dive in with you on that. But a strategic buyer who has a whole set of retail experience might be a better buyer for you than me if we think wholesale is the best opportunity for your company. If we think it's back on conversion rate optimization, Klaviyo and Facebook, and building products and launching them on D2C, then we're super competitive and we think we're a really great buyer for that. But it depends on who your audience is that you want to sell your business to.
I love that demand capture versus demand creation piece. Does that say more about the posture of the business? Because I feel like every business is trying to do business development or is trying to do sales. Is it more of a nature of the category, like your umbrella example? Yeah.
Okay. I picked up from somebody the phrase product DNA. In the DNA of a product category, I'm talking to you using a microphone for this phone call. I'm wearing a men's shirt. I use the example of an umbrella. Those are product categories. You could take creatine gummies that are very trendy right now. It's a product category. Each of those product categories has certain DNA components. It's baked into the LTV of that product category. I'm never going to buy another microphone until this thing dies. An umbrella, I only need when mine blows away or it breaks. A subscription supplement you need every month if you think it works for you and you'll always buy it. there's a DNA to the lifetime value of those product categories. There's also a DNA to the CAC because everybody's competitive in this marketplace and we're all using algorithms to bid for customers on the same couple places. So that CAC LTV relationship is in the DNA of the product. Your cross-sell of your brand. I bought a microphone from some company, but I didn't buy headphones or speakers from them. The cross-sell opportunity of a supplement company, from creatine to protein powder to electrolytes, is a very different dynamic. Men's shirts to men's pants, very different dynamic. So your LTV that expands across categories, even if you have an entry-level product, is dependent on the category you're in. The channels you should be in: wholesale, brick and mortar, online, drop shipping, D2C, what advertising you do, again, is very specific to the DNA of the product category. I think for us, that's a shortcut to make tons of decisions in how we view opportunities for a business, is just thinking rationally about what the category is likely to do through time based on my own behavior or those that I can observe around me.
Yeah. What would be an example of a demand creation category?
The really easy one is health and wellness. You can right now, protein powder is booming. Electrolytes are booming. People are being convinced that they need to go consume salt with their water in a million different flavors and a million different formats. So that's a very trendy category. Anything that can be done problem solution. So health and wellness is an easy problem solution. I'm fat, I want to be skinny. I'm weak or ugly, I want to be strong or beautiful. My hair is thinning, my hair is the wrong color. These are all kind of vanity things that you can sell a solution to a problem for. Anything problem solution is generally very easily done in a demand creation market. Things that are more commodity, things that tend to be more unbranded or undifferentiated, tend to be demand capture by and large.
Got it. Okay. So inherently, you're looking to say, does this potential acquisition have an actual defensible brand that resonates with people, is one way to look at it. So in some ways, you are underwriting the brand, but it's not worth paying excess multiples. It's just a matter of, are you going to pay 2.5 versus 4?
I think that's accurate. I also think that a demand creation brand can capture market share or demand. Right. A demand capture brand can't usually go convince somebody. Like, if you didn't go looking for an umbrella today, it'd be very hard to make a persuasive Facebook ad to convince you when it's not raining and you live in Texas where it's hot and never rains that you should buy an umbrella. You're not going to do that. So we look at that dynamic as far as the opportunities of growth, product line extension, brand development to make that business more in the future. That lens is also an important part of that conversation for us.
Do you inherently just stay away from the demand capture categories, or are those attractive?
We're not against it. It's just understanding that the levers in that business are different because there's only so much demand to be captured, and it's very hard to create sales otherwise. And so we use that as a filter to make decisions on valuation and to see, is there a moat in the business? If it has we have a business that has a really defensible supply chain and a really, really strong manufacturing process that we own and operate, but it's demand capture. I like that business a lot because it's hard to compete with us. We have a moat in making the product, and we're one of the few people that can make a lot of SKUs in this category, but we're at the whim of how much demand there is for it. So pros and cons, great business to own, but I need to know what that business is.
Got it. Okay. The other thing that you said was interesting that you look at on the supply side is just the incremental improvements to the product. What does that tell you about a company if you've been able to see that they have, a version 2 or version 3 or version 10 of something versus, hey, it's the same thing and, we've been doing the same thing for 10 years, so if it ain't broke, why fix it?
It's just an indication of business quality. If you can make incremental improvements to create incremental value, you're probably in a better market where you can meet new customer needs and you're less likely to have obsolescence or a stale business.
Do you find that connection between demand capture versus demand creation and then how much they're iterating the product, is there a correlation there, or is it possible to have a company that is more on the demand capture side but they've innovated a lot?
You definitely can have innovation in product in both categories. Both categories are just an indication of how you go to market and how big that market is and how you want to tap into it.
Okay. And I'm just curious with your decision-making process. Suppose you're looking at an e-commerce business or service business. It's profitable day. You've kind of, you've got your framework, whether it's demand capture or demand creation. What are some indications that maybe give you a sense of, hey, this thing may not may not have staying power?
Longevity. Again, we like to look for businesses that have been around for a while. I would look for, in e-commerce, the review moat, whether that be on Amazon or D2C, just how many people bother to go back and say something nice about a company. Not a lot of consumers take the time to do that, so I'd look for those kind of things. A whole bunch of sales without a lot of reviews is a bit of a flag, a yellow or red flag. And I would just look at the market and understand. I'd go to Google Trends and look at like what's happening. Is this a new thing? Is it a fad? Is it a trend? And try to make a qualitative assessment with that data.
No, that's helpful. Over the last 15 years, we've gone from basically free money, zero interest rates. We had a pandemic. We had, funding dry up for a lot of folks. How has that changed the opportunities that you've seen, as well as what you're willing to pay for an acquisition?
Yeah, I do feel like there is less interesting deal flow, personally, in the last year or two than there was historically. I feel like in 2018, 19, 20, 21, 22, even regardless of maybe cost of capital, I do feel like I saw more and better and interesting companies. And I feel like the deals I'm pursuing now feel fewer and far between. Maybe my bar has been raised and I'm a bit more critical and a bit more selective. Or maybe there's just less businesses being started. I think the funding boom from lower interest rates and the COVID boom did start a lot of businesses, but businesses have a life cycle, and after 2, 3, 4, 5 years, the founders transact, and then the business has changed hands, and it might not change hands again for a while. So I feel like overall, I'm seeing less exciting things less often.
Does that kind of turn into an opposite opportunity for you, where if you were thinking about moving one of the assets that you have, this would be a better time to do it because there's relatively few out there? Or are you kind of like, hey, I only want to sell one if I can buy one, and so I want to hold these things for longer?
We've been working through our portfolio to sell off the smallest businesses that we have to focus on our biggest and best assets. Nothing I own is like nailed to the floor. If a buyer comes along and they're a better owner for it and or offer us too much money, I'm a rational person, I'll part ways with it. But our goal is to build and own and hold a portfolio of these assets. And I would have to reinvest the money. So as an entrepreneur and a husband and dad has to put food on the table, like I need to make a rational decision with my own investing. And so we have a collection of businesses I like that I think are growable and profitable and create a great lifestyle for my family and let us support a great team. So I will part ways with that if it's a good decision for the business and for me and for my employees and my customers, but I'm under no forced obligation to do that at any time. So when it makes sense, we absolutely will. And someday I'll need to refill the coffers with more assets. If that takes me a year or two, I'm not going to rush to buy a bad business or overpay in the meantime.
Yeah, that makes sense. I kind of want to move now to what happens after you buy the business, and specifically what you do. What's your post-acquisition playbook look like? So can you walk me through what your first 90 days look like after closing a deal?
Yeah, it can vary a lot, deal to deal. Again, in the last couple of years, we've been doing mostly special situations where we end up with a real pile of trouble kind of the day we walk into the business. So we can maybe have two answers to this. One is we buy a steady business that has a team and there's no problems and we're just showing up to grow it. And the other is everything's on fire and we're saving the day. Because those first 90 days look a bit different. But in that first scenario, there's a team, it's a healthy business. All we're looking to do is really get it into the 365 way of doing things. We run our businesses on EOS. A lot of people are familiar with that system. If that business is not running on EOS, we're going to put it in. We've got a handful of tweaks that we use to how we operate things. Certain cadences about how we do planning, compensation, communication standards. We want to just get that business working within the 365 ecosystem and get its business unit leader aligned with what we're doing as an organization. That's probably all we're going to do in short order in the first 90 days on a stable, healthy, steady business that we're excited about. Whatever it was already doing, product, marketing, like all that stuff needs to keep happening. If we've got a short list of ideas, we're going to give that to that business unit leader and have them go execute through the regular planning and execution cycle of EOS. On the other hand, if it's a distressed business, there's a lot of things that could happen in the first 90 days. We might be negotiating with vendors. We might be relocating inventory. We might be hiring people. Those are all unique and situation-specific kind of plans.
Yeah, on those challenging kind of dumpster fire type companies, do you and Justin put all of your time onto that and kind of ignore the other stuff, or do you have someone on your team who's looking after them? Like, I guess, how involved is it with, you're like, okay, I knew I bought this thing. I need to put my hands around it and really understand what it is so we can figure out what we bought here.
Yeah, a lot of times those distressed assets will have minimal to no team members, and so we will need to carve out a group of folks from our organization to go to work on that. Between Justin and I, he would be the more operator one that would parachute in to help turn around or operate a new asset. He would assemble a group of folks to help with that. And in very short order, we want a dedicated team, full-time employed, running that business as soon as possible. But if we have a great opportunity to get a good asset that we believe in with a plan we believe in at a price that we're excited about, we're going to go do that immediately and diversify or redirect time elsewhere in order to get that asset in the family. And then we're going to make the next best decision as quickly as possible.
In terms of taking people and putting them on there, I think there's kind of two schools of thought. You could take your strongest players and put them on the worst performing asset, which would be the one you just got, or you kind of keep your strongest players on the biggest, most profitable business. How do you? I think like either answer could be right, and you kind of have to do both. But how do you make that decision in terms of human capital that you're allocating to these things?
Our current philosophy, and this has evolved over time, and it's kind of a continual improvement. Our current philosophy is that we want people focused and dedicated on specific roles in a specific team for a specific business. So any exception to that is done if necessary with a mindset of getting back to that as quickly as possible. So whether somebody's talents are best used on the quote-unquote best business or the quote-unquote most challenged business, we really want them focused on what they need to focus on as quickly as possible. However we can get there with the least amount of collateral damage is the path we're going to take.
That makes sense. Imagine you kind of have to be thinking about having a bench ready before the acquisition is done, just so you kind of know where things go. Do you bring those team members into the business, into the diligence process, so they get a sense of, hey, here's what it is, what do you think, what would you do? Or is it something where you're going to make that decision yourself and then bring them along when it's ready?
The younger, more naive version of us would be Kelcey and or Justin making all those decisions in a vacuum and informing team members what problems we've signed them up for. The slowly maturing, slowly improving version of us is that we are involving more folks in that decision making and giving people a voice and helping us make those decisions. Candidly, I like this new version better. I think it's a smarter decision. And as time has gone on, we've developed a group of people that have more expertise and better diverse opinions than just my own entrepreneurial arrogance. And so it's very, very helpful to get other eyes in the business. At the end of the day, it's my capital, my balance sheet, my business that I'm accountable for and responsible for. So I need to own the decisions. I do want to bring the best ideas, the best inputs, the best guidance into making that decision and make sure the team's aligned with the mission we're signing up for.
That makes a lot of sense. Are there any other lessons that you've learned over the last 15 years that change how you integrate a company?
We are now very focused on being a diversified holding company with discrete teams running discrete businesses. An old version of our business was a very conglomerated, very centralized, very vertical business. Everybody worked at 365. Everybody had a 365 job title and role and description and accountability. And they were shared across lots and lots of companies. And the current version of our entrepreneurial journey is to undo any centralization and really get people focused on being discreetly working in a business, on a team, focused on one objective. That's probably the biggest change over the last 15 years of everything Justin and I have done, is not smashing things together and trying to find synergies or savings or sharing resources, and really, really getting the businesses standing on their own 2 feet.
That's a really interesting insight, because I think so much of the traditional holdco or conglomerate perspective is shared services. I mean, how many times can you point to a big acquisition and, strategic buy as a startup, and then they have this huge corporate overhead charge that comes in. Can you talk about what led you to the conclusion that, at least in this iteration, it is better to have everybody assigned to a specific business as opposed to a few people or a large number of people kind of doing a centralized role?
I think it's our just lived experience. Again, the entrepreneurial passion and idea of, I can do this. Let me figure this out. I'm going to make this great idea of cost savings. And like, why would I pay two people to do a job? I can have them share it. Like, any entrepreneur can get excited about synergies and shared services and putting stuff together. After living that life and debating this with friends and peers and competitors and other business entrepreneurs in different industries, came to the conclusion that the business that we want to be in is the diversified, decentralized holding company business, not the conglomerated shared services business. It's too hard to get the incentives right, and it's too easy to mismeasure and misallocate resources in that conglomerated shared services model from our experience. If somebody has a counterpoint, God bless them. I hope they have nothing but the best experience. I'm kind of jealous. I wanted to make it work. I just didn't experience it. And now I've experienced a different reality that is working for us. I think you have to have a very, very, very homogenous business to really unlock those things. E-commerce, I've got this little soapbox that it's a sales channel, not an industry. So if you have the men's umbrella company and you got the creatine gummy company and you've got the men's dress shirt company, those are different businesses. I know they all have a Shopify store. I know they all run Facebook ads. But there really are no synergies between these three disparate assets. They just happen to have websites and run Facebook ads. They should be run separately. I'm staunchly of the opinion that there is no cost savings or synergy of putting them together. I'm happy to own all three of them if I have a differentiated view and I think that I'm a good owner of those assets. I'm just not going to put them together.
Yeah, that's so interesting. I'm curious about how you made that transition, because I think that it is very easy to kind of say, well, I'm going to go to where things need to be. I'm going to put effort into wherever I'm needed and kind of float there. But you end up usually, kind of working on the worst businesses and not doubling down on the one that's doing well. And so I'm curious about your experience for how you transition that. How did you get the leadership in place that you needed, the incentive structure aligned, that it made sense that these things were profitable and working the way it needed to do, so that you could zoom out a little bit and not have to be in a business per se?
Yeah, I think we saw the portfolio effect of everything we bought had a chart that went up and to the right. Not all of them went up and to the right after we bought them. And we were having a reflective view of the business and doing some planning, and realized that for all the best intentions and all the good ideas and all the strategy and all the problem solving that went into building a centralized conglomerate, that it wasn't giving us the results we wanted. And through experimentation, realized that taking a part of that and giving focus and incentives at the business unit level was starting to drive better outcomes. And so we just shifted wholesale. We told the team, this is what we're doing. This is where we're going. We're glad to have you along for this next phase. You're going to love it. And that's the training we've been on for a couple of years now.
That's so interesting. Was it simply just reallocating people, or were there some really difficult decisions that you had to make in terms of structure or exiting some businesses, or just how you spent your time to make that transition?
I'm super proud of our culture and our team. I think we've got a group of people that I enjoy working with and that enjoy what they do within the 365 ecosystem. One of the things I like to think people maybe are attracted to by what Kelcey and Justin are up to is a lot of growth, a lot of change. There's not a lot of stagnant, same week over week. And so people that want to work in our organizations tend to know what they're signing up for and enjoy it. And so it's not a surprise when there's a new initiative or new effort towards growth and change. We've recruited and retained people that enjoy that type of culture. And so thankfully, we've not had to have a lot of crazy turnover or layoffs or hard things. Have some happened? Absolutely they have. I'm not a perfect entrepreneur. I'm not infallible. We've made mistakes. We've had to say goodbye to good people. We've had hard times. We've had businesses that didn't work out. We've done all those mistakes. But our core businesses and the core team that we have today is super aligned with where we're heading on this decentralized platform, and we're really excited about it.
That's awesome. Yeah, I can see too that the decentralized piece, it probably allows you to acquire businesses easier, because if they've got a set team and you're already evaluating these deals off of, hey, we don't do synergies like you mentioned. It can be a lot easier just to slot them in. You find that you validate you've got good people, you plug them in, and it's kind of steady as she goes.
Yep.
As opposed to, I can see where the conglomerate piece would be hard because that's more of a let's ingest it, let's do a bolt on, things like that. Do you find that your holdco strategy works well at your scale, and maybe it doesn't work if you are massive? I know Berkshire Hathaway is like the one everybody points to, and everybody's going to be Berkshire Hathaway. Like, do you think that there's a difference in size of the conglomerate working or the holding company working?
I think we're just barely big enough. We've got a mid 8 figures run rate for the portfolio. We won't buy anything that is, sub 5, 6, 7 million in revenue. It needs to be really on its way to an 8-figure business itself. I think to have a standalone business, they kind of got to be 8-figure businesses. If you're going to pay a general manager or president to run that business and have a full team and fully burden some costs, like the only thing at Holdco, the only thing is 2 founders, Kelcey and Justin, will act as operating partners that support that president or general manager running that business. The only other people at the Holdco is our CFO and our head of HR. So that business might have its own accountant. That business might have its own payroll system. They're getting a little bit of executive support from the Holdco, and they're getting founders that are acting as an operating partner. We want everything else pushed down to the brand level. And so that means the businesses need to be big enough to support that payroll and that team and that infrastructure.
Makes sense. And so, it almost sounds like the conglomerate piece may have worked when you were working with smaller businesses that couldn't afford everything. So you got leverage that way, and then you kind of aged out of it.
The conglomerate is what got us here. It won't get us where we want to go. Kelcey and Justin had to put a team together, had to do shared services. We never raised any equity. The first business we bought did $2 million in revenue. We've grown organically through acquisitions and through deals and through buying and selling to this much larger organization now, multi 8 figures, several times over. That didn't happen the way we run today, and we would have never gotten to where we are today if we hadn't had a lean, centralized team back when we were doing 7 million or 10 or 15 or 20. We had to do it then to get the opportunity to do what we're doing now because we've done it without any outside investment.
Yeah, and I think that makes a lot of sense. And, I can imagine that for founders thinking about where their business could go, I think this is a really helpful framework, because if you're a smaller business, maybe you're only doing 7 figures, right? You're probably going to be most successful going after folks that have this conglomerate mentality. Whereas if you are, it almost feels like it's like $1 million is conglomerate, maybe 10 million to 100 million or higher is a holding company, and then once you get above $1 billion, maybe that's a conglomerate again. But it's just interesting the life cycle that could look like.
It's the bundling and unbundling that every business goes through. But for us, I think we're just enjoying the current strategy and seeing it working well at this current phase.
Yeah. Well, Kelcey, this has been a fantastic conversation. I really appreciate you coming on. We've got 2 questions that we always like to ask our guests on Build a Business Worth Buying. The first one is, what is the best example of a moat that you've seen a business build?
Keeping it in e-commerce, for us, we have a deep conviction that it is supply chain. Specifically, if you can own and operate your own manufacturing, the speed to market innovation, the ability to control production and operations, to find cost savings and efficiencies in how your marketing and service and ops team works with production and manufacturing, getting really, really tight. It's not a vendor. We're all in the same company here. That really, really is what we think is the most defensible business model in consumer, because we've taken any external relationships or markups or agencies or middlemen or extra cost out of the business by making it not an e-commerce brand, not a micro brand, not a Facebook advertiser, not an Amazon seller. It's a business. It's a company. It happens to have a website, happens to have an Amazon account, happens to do all that stuff, but it's a company that makes products, that sells them to people, and it does as much of those things in-house as possible. That, to us, is the highest quality business that we want to pay the most for, and we think is the best to own.
Yeah, that is so interesting. And, as a supply chain guy, I love that you said supply chain. I hear, especially in like beauty or things like that, people say, oh, well, they're going to use the same co-packers anyways. And so I imagine it's a little bit different based off of the category that you're in. The last question is, if you had to start over today and you were going to build a business you were going to sell one day, how would you go about building a business worth buying?
So I've actually never started a business. I've only ever bought them. So this is interesting. It may not be the best answer because it's going to feel a bit repetitive, but I think it's everything we've talked about, like clean books and a defensible business model and some rational expectations on exit value and trying to understand the market that I'm in and supply and demand. So I feel like I'm rehashing the conversation we just had. But I truly think that like if I left e-commerce today and had to go figure out landscaping or IT services or home healthcare, or I just hit the reset button and started over in products, I think I'd have all those same lenses because that's been the experience of what we've been doing for the last decade plus.
Love it. Kelcey, thank you so much for being on Build a Business Worth Buying. And thank you all for tuning in for this episode. We'll have you next time.
Thanks, Aaron.
Thanks for joining me on Build a Business Worth Buying, brought to you by ISBA Consulting. I hope today's conversation gave you real insights into scaling smarter, selling better, and thinking like a strategic operator. If you found value in this episode, make sure to subscribe, leave a review, and share it with someone who's building their own sellable business. Until next time, remember, the real win isn't just building a business, it's building one worth buying.